I'm really looking forward to this conversation because I can guarantee you, whether it's on this stage or on the ski lift, we would be having this conversation regardless. I'm pretty sure that's safe to say, Julian.
I think that's safe. Yes, I think that's safe.
That's how exciting the lives we live.
Yes, exciting. Yes.
We are going to talk. We're going to get to the precious metals conversation through kind of the dialogue. We're going to set this up first. When you and I were chatting, we talking about past, present, and future. Now, we don't need to talk about the past because I think everybody attending this conference is well educated and understands where we've been. Let's take a deep dive into the present. It's really interesting, both of us coming from America, living in America. Friday at the end of market, we get news that Moody's has threatened, it's kind of like a little slap on the wrist, it hasn't made the move, has threatened to downgrade the U.S. debt. I haven't seen any market reaction to this day because I've just been so busy, so I don't know exactly if there's ramifications, but talk about what this means from Moody's and just a little slap on the wrist, or is there greater implications to this?
No, I think, and this plays to a lot of the stuff that Ronnie talked about first thing this morning. When you look at the long-term structural backdrop for precious metals, it's extraordinarily good. And one of the reasons is this ongoing debt spiral that essentially we're in the Western world. The US is to some degree at the forefront of that, given the post-COVID spending and arguably, I think, even before that, the fact that I think on paper you could argue we're essentially fighting three wars. A kinetic war with Russia, a Cold War with China, and a climate change war. All of those demand inordinate quantities of fiscal spending. And in the US, we have this situation where we just have this inability to meet a political consensus that labels taxation. And so this is something we've been flagging to our clients for a while. We've believed, absent COVID, we didn't have the foresight to foresee that one in 2016. But in 2016, we believed essentially we'd hit the low in bond yields. And we believe that we're in a structural bear market for bonds. We think that bond yields rise for the next 20 or 30 years. And this is a function of not just this need for financing from governments, but that the supply of available funds is just not there. And this is something we talked about at our macro conference in Vail. People just look at the demand for cash and they say, well, that's rising. Rates have to rise to meet that. They don't consider the other side of the equation. And if you look at the pool of available savings, essentially it has been pretty much flat since 2011 when you take in depreciation into account for replacement of capital stocks. And even worse for the Western world is that pool of the savings is increasingly dominantly come from China. The other big player is Japan, who hasn't really increased their share. So it's seen their share actually fall, but it has had at least a steady amount. But it's come from China. And China has, as we saw this morning, increasingly trying to orientate their savings away. Mm-hmm. So the whole West is trying to shove an increasingly large amount of debt down the throats of into a pool that is shrinking. And that is going to be extraordinarily problematic. And the consequences for that, I think, are inordinate long-term. It is going to lead to problems, particularly when you start to pay the politics or the lack of consensus or ability to deliver tax increases or spending cuts in the US, which is going to see more of this sorts of things. You're already seeing it. It gets a little wonky here, but you're already seeing it when you look at things like term risk premium in the Treasury market. That's already beginning to rise. Another way to watch it is if you look at US CDS, so credit default swap, it's actually trading above the UK now, which is, it's a market that hasn't been around for a very long time, only since 2008, but this is unprecedented. Right? This is supposed to be the reserve currency, and their CDS is more expensive than you get in the UK. So these are the long-term factors I think that will continue to drive and be supportive for precious metals, but we've got to get there.
Well, one of the reasons we've got to get there is because this yield curve, I call it yield curve hysteria. And I was talking to mutual friend Barry Knapp about this last week. And I asked him, can you please make sense of this? And last week we had an enormous amount of supply coming in treasury auctions from the 3-year to the 30-year, I think it was. The 3-year was okay, the 10-year was meh, and the 30-year auction was absolutely terrible.
Right.
So you're watching these auctions, and not everybody's going to, sit down there and nerd out on the macro and watch every single treasury auction. So give us a sense of what we saw last week throughout the yield curve, and are we getting any clarity whatsoever?
So I think, we'd seen this. There's a couple of things going on here. The first thing is, when you look at rates, say, versus equities, so far, as the Fed has tried to tighten policy, what has really taken the brunt of the strain, right? And remember, policy tightening starts via financial conditions, right? That's how you disseminate it into the broad economy. You affect bond yields, you affect credit spreads, you affect equities. So obviously, US equities have been incredibly resilient. So all the brunt of the tightening has really been borne by the fixed income market, by the bond market. That's where the tightening has had to come through. So in part, the sell-off that we saw, the beginning of the rise from we recommended first week in August for our clients to sell treasuries, and it was like 4.1% or 4.09, I think, or something. And our target was 5. I mean, better to be lucky than smart. But the reason we were doing that is because of this ongoing resilience in the economy and the equity market. If equities won't go down and you still have to slow the economy down, something has to take the strain. So we get to 5%, then we have a series of events that have worked to help initiate this rally that we've seen and this back off from 5. Firstly, Treasury has started to get worried about funding. So, the US is going to be rolling 30% of its debt over or approaching that number in the bill market. That is utter insanity, okay? Utter insanity. But that's the reality of the situation because there is not the demand out there for the long end of the curve.
Maybe we ask, who were the buyers and why are they not there right now?
Well, there's a slew of different buyers. So there's a group of buyers that are called cash and carry. So if short-term rates are low, longer-term yields are higher, you can leverage up and you can borrow short, lend long, right? Classic kind of stuff. There are the asset managers. Well, the asset managers actually generally bought back in the summer have been crushed in this movement from 4 to 5 in 10-year yields. They're not inclined to buy anymore. There's sovereigns. Well, sovereigns typically buy when the dollar is actually weak, and a large proportion of that is the mercantilists in Southeast Asia who are trying to support their currencies and stop them getting too strong, so they'll end up buying dollars and selling Korea against it, taking those dollars, reinvesting them in the treasury market. They're not buying. The Chinese, as I said, are not buying. US individuals are not buying. Why? Because they've been educated over the last 10, 12 years to believe, hey, I can make 12 to 15% in the equity market. So why the heck would I take treasury risk at 5? Right? So this is an ongoing problem. The buyers are just not there at the moment, and the dynamics have to change. So you've either got to beat it out of equity investors in the US, right? They've got to take such large losses that they go, okay, I'm quite happy with 4 or 5%, or some other dynamic has got to change.
Could some of that cash just be sitting, like just not doing anything?
It is sitting.
Unless you're buying in like the Mag 7, right? The only companies that are actually lifting this equity market up. Unless you're doing that and you are a bond bull, I don't, what else are you doing? Because I don't see anywhere else that's making moves.
No, I mean, look, people are putting cash on the sidelines, but they're not taking duration risk, right? They're not extending down the curve, right? Up until recently, very recently, the term risk premium, which is essentially the insurance premium you demand for taking that duration risk, was negative. So in other words, you were better off just taking your money and investing it in the overnight and just rolling it and rolling it and rolling than you were taking the risk of a 10 or 30-year bond. I mean, that's bloody insanity, right? But that was a result of all of this layering on of negative interest rates and QE and yield curve control. That's where it got us. And we all believe that it's the norm. delusional. It's utterly delusional. This whole positive correlation, I mean, you want to take things further, this whole positive correlation between bond and equity, sorry, this negative correlation we've had recently between bond and equity prices, not bond yields, but bond and equity prices, has only persisted since 1998, when Greenspan started to come in and get concerned about deflation. Prior to that, the Bank of England did some work. For the preceding 230 years, we had never, ever, ever had negative correlation between bond and equity prices. That's what's led to the whole 60-40 portfolio, risk parity, all of these things. These strategies, this is the illusory period. If we are going back into a world, which I totally agree with Ronnie, of deglobalization, conflict, re-onshoring, okay? Mind you, AI maybe can save us, but that is the golden ticket. That's the only one, okay? In that environment, all of these structural things that we've got very, very used to become very, very different. And that ultimately creates opportunity for you guys, I think, because it's going to force central banks to move and make decisions which are abhorrent to them. I mean, really unpleasant, right? At some point, we've written about this to our clients, there is a shift which occurs where a central bank is essentially forced to make a decision. They typically operate in what we call monetary dominance, so monetary policy is the dominant power between monetary and fiscal. And yet you can reach a point where you hit this fiscal limit, a point at which the market will not absorb government debt. And it starts to be a problem and it starts to spiral out of control. And at that point, you typically switch to fiscal dominance. Now, there are times when it's totally justifiable, okay? Second World War, totally justifiable. Fed comes into the bond market, those are your rates, your name's the Fed, get lost, right? How much do you want to give me? Fine. How much do you want to buy? Doesn't matter. That's the rate. You're done, right? And you don't concentrate on inflation, and you don't concentrate on maximizing employment. You concentrate on stabilizing the debt. But you have to get to that point, and I think it's not something that the Fed will want to do. They will fight it, at least to begin with. Do we end up there? Yes, we end up there, I fear, certainly on this projection, given the politics in the US. That's when gold becomes incredibly attractive. But I do fear that I listen to a lot of people, and look, I'm bullish on gold at the moment. I'm long. I really want to see it break above 2050. I think that's the breakout level, and I'd buy more on that for a move to 2400. But I fear it may take a lot longer than a lot of people think, because I just don't think people understand short-term what the Fed is trying to achieve. They look at the drop in inflation and they go, well, that was easy. Well, we're done, right? 75, 100 basis points of rate cuts next year, off asset prices go again. And that, absent that productivity thing, is just delusional. We are going to sit here for a long, long time and grind it out. And it's the problem that policymakers had, and the ECB is pursuing exactly the same policy as the Fed, and is that they just had they've done an appalling job of explaining to people, for whatever reason, the policy path they intend to follow.
Well, they like to paint this facade of higher for longer.
Right.
So we can have this conversation, because I'm hearing a couple different things from a little bit of that tangent, Julian. Like, something that taken in my head is you somewhat described a mandate shift for the Fed within what you were saying. So do you see them stepping away from, as little unemployment as they can get, and then the inflation mandate of like close to 2%, to where basically they're just there to keep the boss happy and sovereign? I guess there's that. And then the other thing let's just start with that, because that's a big.
So the answer is ultimately.
A long time.
Ultimately, but it is a Rubicon event. It will not be taken lightly. I do not believe it will happen without a considerable degree of pain. And at least initially, they're going to try and maintain monetary dominance. And that's what I think investors are overlooking. They're just going, well, it's going there. Okay, fine. I don't necessarily disagree. And they're forgetting the path. And the path is very important, and timing is very important. And we're not at that point there yet. We've got to get there, Trevor.
Okay, so then, this central bank, the Federal Reserve, keep on saying we're data dependent. But if we're casual observers of just everything happening in the real world, we were talking earlier, just traveling here, the hysteria of airports and travel and the expense of getting here. And it's not even that, just ordering some pizzas and a nice bottle of wine with your significant other, how much that costs. I think it's a sound argument to ask, in this higher for longer tightening cycle, it just doesn't merely seem tight enough.
Well, so the Fed and ECB were faced with a very stark choice when they got the inflation story wrong.
It's transitory.
Yeah, it's transitory. So there are two policy options available to you as a central banker. There's something that's called deliberate disinflation. Now, if you want an analogy, deliberate disinflation is you walk the economy into the back garden, into the pool, and you take its head and you shove it underwater till it drowns. Deliberate. Dead. That's what Volcker did. Okay? Clearly not an option you would choose. And certainly there's no political consensus in the United States at this point to do it. You've got to remember, Paul Volcker came in after a very extended period of high inflation, which people were sick and tired of. Option number two, opportunistic disinflation. And this is the policy path that I'm told, and I firmly believe, and you can pick up from the rhetoric, that they are pursuing. Now, opportunistic disinflation, if we go back to that analogy, is you walk the economy into the back garden, into the pool, and you shove its head to the point that it's spluttering. Now, you haven't drowned it deliberately, but it's spluttering. And that's not a great place to be. And here's the big takeaway. Because you didn't drown it, because you didn't take the terminal rate to a level that truly killed the economy, the trade-off is you have to allow it to splutter for a lot longer than people envisage. And the bond market still, and the equity market is relying on this assumption that we are just walking rates up and that we are walking them back down again. Now, I don't necessarily preclude the possibility of small adjustments to interest rates next year if inflation does come down, because in real terms the Fed won't want them to rise too much. But the only other time that we have pursued opportunistic disinflation was in the mid to late 1990s. And if I told you what that inquired, you should be scared, because it was 4.5 years of essentially unchanged interest rates. Not 6 months, not cuts in March of next year, 4.5 years to grind it out. And if, by the way, you get a recession, c'est la vie. Not my fault as the Fed. I didn't deliberately cause it. I just took opportunistic advantage of it. And this is what they will have to do, unless they get insanely lucky. And oh, by the way, Greenspan got insanely lucky, because it's entirely possible that this policy won't even work. The Fed was it back then where he wrote about how they were internally divided about it, because there's a real risk that the policy takes so long to grind it out that you lose inflation credibility and you lose control of the long end of the bond market. And the pickup in the inflation, the Michigan inflation numbers and the New York inflation numbers should begin to worry them. And if at the moment they think that that's happening, then they really have to hammer the brakes. But the point is this is a policy regime that we live in now, and this is the fundamental problem, I think, facing all investors at this point. If we have to sit here and we have to grind this thing out, right, we might not kill the patient, but tight monetary policy demands tight financial conditions, and tight financial conditions, because they are a function of the bond market, the equity market, the credit market, and the currency, means that those have to stay roughly where they are for a long time, which means a balanced portfolio makes nothing. So if you make on your equities, you have to lose on your bonds. If you make on your credit, you have to lose on your gold. And we just have to sit here in this range and play one asset off against the other unless we get really lucky and starting, next week, this AI thing kicks in.
Who knows what Elon has up his sleeve? But it's not going to happen next week. I can guarantee that. I do think the long-term trajectory of AI is very positive, but there's so much we just don't know, and obviously it's to a point where governments are already trying to regulate it for many different reasons. Different conversation that we need to have now. But I want to ask, so listen, the equity market is just so very reactionary and short-term thinking, because we come out a couple of weeks ago, the Fed comes out, and the equity market is saying they've paused, they're done, no more raises, buy tech. And that was the reaction. It's the same reaction that they've been waiting for the last 8 months, because they have been ingrained in that since, basically 2012, but COVID really expedited that. Lower interest rates, buy calls, buy tech, move the equity markets higher, buy the dip, stonks only, move up. How much is that still ingrained in this new generation of traders and investors?
Well, I think, typically, look, you didn't used to buy. The Fed would go on pause. And usually they went on pause because things were really cracking, right? Typically the ISM manufacturing was below like 48 or something like that. We're moving into the recession. They go on to pause. And then the next stage, they start cutting. And then only halfway through the recession would you typically start buying stocks. And particularly when the dollar started to weaken, which in itself, given it's the reserve currency, is a very reflationary event, that's when you could kind of pile in. And Ronnie had the chart showing silver like massively outperforms in that stage 5, because it's a super high beta anti-dollar trade, right? We've all got very used to that, but particularly because of the advent of QE, it's even more powerful, right? Because typically just in an interest rate environment, you had to wait till sort of halfway through the recession. You did get the sell-off. Now we're like, wait a second, we don't even have to wait for the sell-off, because they're just going to come in. As soon as they pause, the next thing's going to be the ease, and then they're going to come in with QE. And that is the crack cocaine for the equity market, right? I mean, you reduce the value of the denominator by printing a lot of it, right? That's the crack cocaine. And you just go straight off to the races. There are many problems that I haven't got time to go into them as to why I don't think that's possible. The feedback loop between the behavior of CEOs and their stock prices, to the point that if their stock prices never go down, it's very difficult to get them to fire people. You never get the slack that enables you to get that dip, to have that growth spurt again. I don't want to go there. But the point is the equity market has been, certainly since 2009, preconditioned that pausing means more cracks coming in the form of QE, not necessarily just rates. And I truly believe that it's going to take a lot more to get QE going again, unless it's related to a government debt stability issue, because within central bank circles, QE is increasingly being questioned, both from a moral and an efficacy perspective. And I just think it will be something that they will really have to think twice about.
So the idea with the next round of whatever we call it, QE, whatever we want to call this, moves away from keeping the financial institutions solvent and transitioning to keeping government solvent.
I mean, look, it may come from the banking sector again. The banking sector in the US looks like a train wreck.
Yeah, absolutely does. But there's a lot of slack in there. I mean, in the United States, we have 2,400 different banks. But Canada has 4 or 5.
Right? So, maybe there's another solvency issue, but we do have the bank credit funding facility now, so that helps. It's difficult to know exactly where it comes from, but I think this idea of another wave of QE infinity, right, or QE 3 or 2, where they just go, we'll just keep printing. I mean, that's when Janet Yellen did QE 3. Just until we've solved it. And you sat there, you went, really? I mean, I'm doing a calculation on the S&P where you could look at the end of QE1 and QE2, and you could figure it out per 100 billion of QE. It was like 51 points on the S&P. Like, this was mechanics. This isn't central banking. This is clipping the corner off the gold coin, right, is monetary debasement, right? And suddenly you've got, if you clip 10% off the thing, you've got 10%, more money, right? That's exactly what this damn thing was. I mean, it was that simple. So, but it has created problems. I think it is a tool that in emergency uses, such as the bank credit facility, maybe we get another repo problem at some point. Perhaps they will do something. But this idea that we're just going to get another, with the easing next time, with the rate cuts next time, that it's followed up with another wave of QE, I think could come as a shock to equity investors when they don't get that.
It's testing the Fed put.
Yeah.
To extreme.
Yeah.
Do you think the Fed put is dead?
Ultimately, no. But it's a lot lower than you think.
Explain that to me. What do you mean a lot lower?
I mean, look, if you have to hold financial conditions steady for an extended period of time because you are trying to hold growth sub-trend, right? We are still growing in the United States, 6% nominal GDP on a year-on-year basis. Quarter-on-quarter, 8%. What, are we an emerging market? Okay? A recessionary level a shallow recessionary level, a soft landing would be like post the dot-com bubble, okay? And we got down to 1 year over year, right? 1. So the Fed has to grind this thing slowly down, and it means holding growth at a low level. Trend is 1.75 in the US in terms of real growth, 1.75, okay? So 1%, let's say, they have to hold it there. That means they have to hold financial conditions there. And that means, very simply, that as the equity market tries to rally, the bond market has to do the tightening for them, or vice versa. So, at some point, you're going to get to that point, Trevor, where, let's say, we go back up to, new highs. That's not my forecast, but let's say the equity market does go to new highs. So the bond market goes to 6 or 6.5. Something is going to break, right? It is going to break. And where does the Fed come in? Well, they're watching financial conditions. They can't allow this thing to go. And because they need to allow this to grind out.
Well, the politicians also need to prevent that from happening. We have a president in re-election that obviously is spending an incredible amount of money that's helped us to get to this point. The front runner on the other ticket, we'll see what happens in November. I mean, he has an incredibly reckless past of also spending an enormous amount of money. This will be politicized in the United States one way or the other, and they'll do it for votes. So, I mean, I guess I'm saying this in challenging your thesis a little bit, because in an election year, I mean, let's be honest, they'll try to make anything happen just to get back in office.
Well, look, I think fiscal is not going away, right? I mean, I think Donald Trump, even before COVID, unlocked that Pandora's box. And politicians' eyes sparkled, right? You've just given them this inordinately big tool, right? Oh, this is how I get reelected. And that's what they've been doing. And people who are far smarter and far more focused on this that I rely on for my input just tell me that the concept of fiscal rectitude, at least in being an election item in 2024, is very, very small. So we have to wait for the next election cycle. So in the US, we're realistically looking at 5 years from now when it could start to become an election issue. But it's only going to become an election issue if it becomes a crisis. So sometime in the next 5 years, if you're expecting that you've got, a Ross Perot, for those of you old enough to remember him, who was concerned by this sort of thing, the way that you get to a Ross Perot is you get there by having an inordinate great crisis in the Treasury market. That'll get it to be an election issue. Absent that. So I just don't see the fiscal rectitude. And God forbid, Trevor, we go into a recession. I mean, if you want to see the deficit blow out, it'd be rather interesting if we went into a recession and the long end rates didn't fall, or the term risk premium blew out even more, and US CDS rates blew out even more. Right? That, I think, would be really intriguing.
Well, you say if we hit a recession, so are you on the fence if we?
No, I mean, I think, look, like equity markets, like any asset price, right? They generally don't do well when they trade sideways, right? If you look at equity markets, you know, and the way that CTAs work and with their moving averages and so on and so forth, most things are a momentum game, particularly in the US. Like the US is not an economy that ticks over well at sort of 1% growth, because at 1% growth, you're not getting earnings growth, your stock prices aren't going up. The CEO turns around and goes, how do I get my earnings growth? I know, I'll fire some people. And so then you fire some people and you slide into a recession, right? This is just not, you know, Europe can function much lower levels of growth. The US is not like that. So, yeah, I'm just saying, I think in this grinded out kind of environment that we're going to be, I think there is a significant risk that we slide into recession. I think we know that there's lots of areas of the economy that cannot stand another round of significantly higher funding, right? Whether it's commercial real estate, whether it's consumers who are going to be, oh, I'm going to bet that $1,000 car payment is no longer $1,000, it's $1,200 because all of a sudden it's not 0% and, you know, 0 down and 0%, right? It's 10% down and, you know, 10% or 12% or whatever the number is, depending on your credit rating, right? So these things, I think there is a risk that, and on the margins, we're definitely seeing stuff slow, but are we seeing it to the point that it's recessionary? The signals, I still think, are mixed. I think we'll get there, but we'll get there because we'll slide into it, probably, rather than anything really dramatic. The only dramatic way we'd get it is if tomorrow you had a big liquidity withdrawal, stocks went down, then you'd get your recession within 6 weeks.
I want to go back to a potential moment of crisis in the Treasury market and maybe shift away from the Treasury market kind of being, that crisis being subdued by fiscal policy. And when does it turn into political policy and the government putting in mandates or regulations in terms of financial repression, deciding where capital inflows can lead to and what cannot? Is it impossible for government, they've already started, you know, holding your crypto? Or do you need to have certain, you know, pension funds having a certain amount of capital allocated to 30-year treasuries? Yeah. You know, where does it become a political situation where governments set in and start forcing financial repressions of what can and cannot be invested in?
So in that process that I talked to, that you could slide from monetary to fiscal dominance, where you reach that point where there are question marks about the stability of government and the sustainability of debt, and the central bank is forced to act, right? At that point, as an investor, you have to be, and from a personal portfolio management perspective, you have to be extraordinarily careful, because it is entirely possible at that point you're doing insanely well on your gold portfolio, gold's sitting at 5,000. But at that point, in that process of moving from monetary to fiscal dominance, you need to expect a raft of other controls to be put in place. I have Republican contacts in DC who say there are factions within the Republican Party who are talking about exchange controls already, that at some point there's inevitability of exchange controls. Freely floating currencies have only been around since 1972. Okay? I'm old, but I'm old, and I wasn't that old when it happened, but it was in my lifetime. Okay? This idea of these laissez-faire, free market, free rolling markets are a new construction, and it's generally not how the world works. And so, the point, and this is always my concern about crypto, and we've had these conversations all along. So I do this product with Raoul Powell from Real Vision, and we talk, he was a big crypto guy, and my argument with crypto was never as a trade, but it was always as a store of value. Because my concern is crypto was too good. Crypto was too good because it allowed you to circumvent the rules and to challenge the man. And I remember sitting in a conference in Aspen, they're sort of what they call their blacklist. And this is a bunch of kids in their mid-30s who'd made a shed load of cash in crypto. And I remember having this conversation with one of the guys, and I said, he said, well, the big advantage of crypto is they could never track it. I was like, really? They cracked those uncrackable cell phones in Europe where they were completely sealed and they were handed out, and they managed to do that. And you don't think the NSA could figure out that at some point you moved money from JP Morgan to Coinbase and that you must have something. And what happens the day when they say, yeah, the dollar's under a lot of pressure, people are using crypto to circumvent the system, we need to shut it down. And they come to you and they say, we're buying you crypto off you for, $20,000 a coin, and it's 100. And this guy's, well, they can't find me. And I'm like, okay. So they find someone, and they take him to a court in Texas. And you know what Texas is like. The guy will get, found guilty and thrown in jail for 200 years. I remember having a conversation with a Texas senator about the chairman of Enron when he was being challenged. And I will never forget this saying where he said, you don't understand. I don't care what happens to the chairman of Enron. I just want him to get thrown in the deep, dark hole with a boy called Bubba who calls him Shirley. Okay? And when the guy, the crypto coin owner, gets thrown in a deep, dark hole with a boy called Bubba who calls him Shirley, what do you think your wife is going to say to you about your holdings of crypto? You're going to hand it over. So I think if we get to that point where we slide, which I fear is inevitable, to that fiscal dominance point, you have to expect a raft of controls. You have to expect things like minimum funding requirements in pensions, where they will turn around and say, oh, so insurance company, you've got a 30-year liability. I think you need to match that with a 30-year asset. And we've got this lovely, shiny one here for you. And they will regulate that. We've seen that in the UK. We've seen it to some degree in continental Europe. That sort of stuff is going to come. You need to have exchange controls. You've got to think where you have your pools of assets. If you're one of the, the global elite and you like to spend your summers in, Europe and your winters skiing in the US, you're going to have two pools of cash that you can draw upon, right? Or you're going to have them in some jurisdiction that's not going to care. And so, there's lots of planning that has to go with that. But yeah, bottom line, Trevor, if we get to that point, right? And that's not even really nasty, right? Really nasty, there's only two metals that count, right? Lead and brass, okay? Because I can pretty much lead and brass, which is a bullet, I can get your gold, okay? If it ever gets that bad, I'm just getting a bottle of Bordeaux and a few tablets. I've seen the road. It was a scary movie, and I've no interest in living that. But before we get there, okay, I think there's that interim point, and even in that interim point, you have to expect, and you have to be prepared for governments to take steps to maintain their survivability. And it will drag, given what's going on between East and West, it will drag a lot of countries that you might not necessarily think. I don't know whether Switzerland would be able to hang out and keep doing its things in an environment where the pressure from the EU and the US was so acute to lock that thing down, right? If they're talking about their own solvency, right? All these rules can get changed. So it's something just to bear in mind.
And I know we only got a couple minutes, and if there's questions, we're going to get to it. But my last thing is, we are all precious metals and precious metal equities. I would assume most of us dabble in the resource exploration stocks, obviously a global environment here. Me personally, like I was just thinking, like, I mean, I have investments from Kazakhstan to Colombia, right? So it's all over the world. Do us retail resource speculators need to be cognizant of exactly what jurisdictions we are putting our capital towards, or is it going to matter as long as they're mainly traded on the Canadian Venture Exchange?
I mean, it depends what you want to do with the money when you sell them, right? As I said, I mean, if you're purely US, I mean, I don't think they control the equity market. I don't think this time they take your gold away like they did in the 30s, right?
But could they keep you from investing in, say, Kazakhstan, which is now on the front line between China and Russia?
Absolutely. I mean, essentially, moral suasion has stopped American investors investing in China. There is no big pension fund, endowment fund that is allocating huge amounts of cash to China because the optics of that, okay, if something goes wrong, are just too great. So sure, they can stop you doing that, right? I'm not saying you can't make money out of those things, but if you truly want to think about protecting clients' assets, protecting your assets, then you have to have them in multiple jurisdictions. As US citizens, that's actually pretty hard to do, but you do.
We have 2 minutes if we have one or two questions.
Or you're so scared you just need to grab a bottle of red
yes.
wine. And
we're also the last speakers before the cocktail reception, so we may need a cocktail now. Julian, so we've answered all the questions.
I think we got a couple.
Oh,
I'd beg to differ on the point of that you made about cryptocurrency, in particular Bitcoin. We're beyond the stage now where the maturity and the actual global adoption across multiple ecosystems, across multiple countries. We have financial regulators regulating it heavily. It's not finished. There's still plenty of homework to complete. But I'd like to mature the conversation around specifically the relationship between, it's not an enemy of as an asset class towards precious metals. I'm actually in both myself. I'm actually building a Bitcoin mining company right now. And I just would like to bring more maturity to the aspect of how it's treated. And I would.
Well, look, you and I can have this debate offline. And all I will say is they won't get rid of crypto, right? But the Chinese have already banned it. And if a certain country comes under significant enough pressure, they will ban it. So look, if you live in the Caymans, you're arguably a British citizen, it isn't going to be an issue, fine. If you're a US citizen, it's a completely different kettle of fish.
China's one of the biggest Bitcoin miners in the world. So
I'm not saying mining, mate. I'm just saying owning it as the get-out-of-jail-free card, right? Because the reason why they restricted individual ownership is people were using it to circumvent the capital controls and stop the capital flight, which they wanted around the renminbi, right? So fast forward 5 years, and the dollar is under acute pressure. Treasury yields are 8%. Inflation's exploding. The solvency, US CDS is at 300 basis points. And do you think they're going to give you a get-out-jail-free card where you can take your money and you can shove it offshore? You're delusional. I'm sorry. This is big boy politics. They did it in the 30s. They'll do it now. And it's about maintaining the solvency of the entity of the government. And that's far bigger than what happens to some coin.
I think we had another question. Right up here in front, see if you can get... And then that's a wrap here, I think.
Yep.
Thank you very much for the talk. I was curious, you spoke about the reasons why you think a new round of QE isn't possible or isn't likely. Could you just expand on that a bit?
So there's a lot of, I think we tend to forget, I mean, central banks, I hung around central banks for 20-odd years, and you meet these guys, and they have you look at them and they're public servants, right? Jay Powell doesn't need to work. Right? He chooses to work for a paltry salary that most of us would not even bother to get out of bed for, okay? And he does it because he has a sense of moral obligation. You can call it patriotism, you can call it service to society, whatever. And they have this deeply moral compass. I mean, I've sat with a Fed governor who has said to me, you know, I went to my child's college and there was this mentally handicapped person there, and he was employed because unemployment was so low, right, that they had to employ him, and it makes me feel good. That's one of our roles. And so a lot of the re-examination of QE is that it had led, and it has encouraged this wealth disparity that we've got in society. And so there was always, at least at the beginning, this assumption that it was costless, that it would trickle down and everything would be great. And now there's just a rethink. And also there's a rethink of the difficulties it's presented them into trying to, the balance sheets have got so big that they are in this danger of owning everything, and they have no bond markets. I mean, look at Japan, right? They have no debt to the bond market, and what do? So there's a moral issue here, and there's a technical issue here, which I think don't get me wrong, if we got to such a bad state, or if governments are really up against the wall in terms of funding, and this is when gold will take off, the central bank will come in, okay? That is that shift from monetary to fiscal dominance, where they say, bond yields are 7%. They say bond yields are 4%. Your name's the Fed. Now go away. Okay, and obviously they're going to do that with QE, but it's going to take more. And certainly this idea that a 20% equity dip in it of itself, with no other asserted problems, just elicits another wave of QE. What are we on now? 6, 7? No.
Thanks, everybody. That was a great conversation. Julian, it's good to see you.
Thank you, Trevor.
Pick it up again on the slope.